So yesterday, the US Treasury did something it normally doesn't do. It started buying back its own long-term bonds, which sounds completely backwards. The Treasury is normally the one selling bonds to investors. I'm Gaurav, I am an ex-McKinsey consultant, investor and founder, and I break down business and economic stories without the jargon. On Tuesday, the 30-year Treasury yield hit its highest level since 2007, pre-financial crisis. Same day, US government debt crossed 40 trillion, the highest it's ever been. Now, yields rising basically means lenders want more compensation to lend to the US government. More risk, more return demanded. So when yield rises, the government's borrowing gets more and more expensive. So the Treasury stepped in. It started buying back its own long duration bonds. Simple logic, when demand for bonds goes up, yields can come down. Suddenly, the Treasury itself is a buyer in the market that it usually sells into. Now, the actual buyback amount is small. It's about 4 billion against a $32 trillion market. So it's not about the money, but the signal that it's sending out. The Treasury actively stepping into that lane tells you how uncomfortable they are with where the long end is headed. So why would they care? Well, the US government pays interest on $40 trillion of debt. Every basis point increase in interest rate along the long end adds real money to that bill, year after year. Rising yields also mean higher mortgage rates and pricier corporate borrowing, right as the economy is trying to fund an AI infrastructure rollout. A government already running structural deficits can't afford to let long end yields run unchecked. At that scale of debt, there are really only a few levers you have to bring the debt burden down. So the options are austerity, which is essentially cutting spending and raising taxes. You can restructure or default on your debt, or you can print money and devalue the debt over time, which the government can do as all of their debt is denominated in dollars, own currency. The buyback is a live look at which lever the government is reaching for. Because austerity alone is too painful, invariably the path of least resistance, which is lowering interest rates and monetizing debt, is almost always taken, which is what we're seeing happening now. But until the structural issues are fixed, that's just kicking the can down the road. A structural fix would require a combination of all of the levers, so higher taxes, lower government spending to reduce the fiscal deficit, balanced with lower interest rates to keep the economy from seizing up. Beautiful deleveraging as defined by Ray Dalio. Focusing on any one in isolation is a fool's errand, and it can overwhelm the system. Tomorrow, I'm getting into why yields have been climbing before this intervention even happened. Feel free to follow along if you don't want to miss it.